I'm Bill Baruch, president of Blue Line Capital. I'm here with our analyst, Giannis Meindl, and this is the Triple Play podcast where we introduce the macro overview and then we jump into three individual stocks. So let's hop in it. Giannis, start us off with the macro.
Yeah, thanks, Bill. So we really continue on a slew of economic data, and last week it was PPI that was particularly relevant. Came in at 6.3% on a year-over-year basis. We saw a continued deceleration. One of the more sticky components was, again, food. But as we talked about, fertilizer prices sort of being that leading indicator of rolling over sharply. So this is really still a story of producers passing on the inflation that they saw last year onto consumers. But as that sort of works its way through the system, that's also expected to decline. One of the dynamics is really that the energy keeps decelerating sharply, and maybe it is a little bit of a tail risk. Back in June of last year, energy still contributed more than 300 basis points to PPI. Back last print, it was closer to 50 basis points, so drastic deceleration. And then as we turn our attention to the next consumer price inflation price index print, 1/3 of that is shelter. And that's also been the more sticky aspect of the entire inflation story, as the Fed has talked about. But one encouraging dynamic within that is definitely that there's going to be a lot of houses, single and multifamily homes, that will be coming online. Construction compared to 2019 levels is up somewhere in between 40 to 50%. So that will be a lot of supply, as some of the demographic shifts will demand new houses. But the good thing is there will be more supply, and as mortgage rates continue to remain elevated, we'll see how much demand there will be. But Bill, turning over to you in terms of economic data, what are you currently watching?
Well, as you pointed out, the inflation, it's given us light at the end of the tunnel. The Fed's rate hikes have begun to slow inflation overall. I mean, some of the inflation as well is just sort of working lower. I think generally as you get higher base comps. But the Federal Reserve still has their work cut out for them. Look at the data today. GDP for quarter four came in at 2.9%. That's a plus 2.9%. So we're not in a recession, and this expectations were for 2.6%. Durable goods surged. Obviously, it was aircraft orders were big there, but still the core number only fell 0.1. They're looking for a drop of 2 or 0.3. And the jobless claims, I think that's the real big highlight. Jobless claims, initial jobless claims came in at the lowest level since April of last year, when the Fed started to hike rates. So, I think that we're seeing the economy really roll along. Consumer spending as a component to GDP was still very strong. And I was on the CNBC halftime report yesterday. I've been talking about it here. I've noted it there. I expect retail sales this January month-over-month read. Yes, it is a rebound from December. Okay, December was poor. November was lukewarm. But I expect a blowout January retail sales number. And we've seen that the last 2 years as well. In fact, out of the last 2 years, 2 of the top 3 month-over-month retail sales numbers have come in January. Again, yes, it's a rebound from December, but it's a blowout number. Nonetheless, it's a holiday. The December's is supposed to be a holiday number, and we've talked about it here. We've talked about it multiple times across different outlets. But as you get into the holiday season isn't what it used to be. So I think we're seeing a lot of a very strong spending number. Continue to see spending, It may be the Fed sort of crushed some risk assets. They crushed, the crypto area. People aren't trading those monkey JPEGs anymore, but zero DTE options. I mean, there's a lot of volume there. So the Fed may have some froth still to take out of this market. I've really flipped my case from where I was late December, the start of this year, where we may not even see the Fed hike at all into February. But as this data has sort of evolved, and as my mindset around it has, if the Fed hadn't backed themselves into a corner of 25 basis points, I do think that 50 would be on the table. I expect to see, more hawkish Fed Chair Powell, maybe than we've seen the last couple of times we've heard him speak. So it'd be interesting next week. And obviously, that will have surrounded by a lot of earnings on deck too. So, let's move on. We'll start off here with Thermo Fisher. As our first stock. This is one that we've owned for a couple of years. It's really since launching the advisory. It's been a terrific name through the COVID period of time. The diagnostic space in life sciences is definitely something that not only that capitalized from COVID, but as we look to move away from just this sharp focus on COVID and getting through it. We expected not only life sciences, diagnostics, but some of the pharmaceuticals. There's going to be names within the space that really capitalize, and TMO was definitely one that we've leaned on. It had a really great second half of 2021, but it may have gotten a little bit ahead of itself. The space still very attractive, a lot of ebbs and flows. Recently, this week actually, due to Danaher's numbers. It has traded lower, sort of. It's a little soft tape at the moment in Thermo Fisher, but the multiple still sitting around 26. It's not cheap, but it's not super expensive right now. Giannis, what's your take on TMO here?
Yes. So in terms of the segments that Thermo Fisher has, we have the life sciences being the higher margin aspect, and then we have specialty diagnostic analytical instruments and the lab products. And one of the more concerning trends on the back of what they have profited off of COVID is that the life sciences, which includes a lot of the COVID testing, has really decelerated. We saw revenue down 20% last quarter. We also saw a steep margin compression. In prior quarters, life science margin was closer to a high 40s, 50s, and that's compressed down into the low to mid 30s. So that is one trend. Back in 2021, they had about over $9 billion in sales related to COVID testing and those analytics. In 2022, that was about $6 billion. And going forward, they expect about $100 million a quarter of revenue related to the COVID testing. So that's definitely slowed. And how they manage that transition into this new phase is really going to be key. I mean, there are multiple secular trends in terms of pharmaceuticals that keep spending. R&D spend from pharmaceuticals globally will increase by about $45 billion until from 2022 to 2028. And then we have the potential of some upside risk there in terms of some more accelerated drug discovery with AI. We saw Google's DeepMind come out with AlphaFold that might help with some of the gene editing and maybe making some progress on the cancer side. But in any case, in case there's a breakthrough, then drug discovery will be accelerated. And ultimately, that will mean more companies are going to put more money into it. And really, TMO's products are indispensable in that regard, not only on the diagnostics and life sciences, but also the equipment that they provide. So that's really the outlook here. It's not a cheap stock, like you said. It's higher than the index, but that's sort of the premium that you pay for a growth story while also having that stability that TMO provides. But in terms of price action and portfolio allocation, how do you think about that, Bill?
Yeah, and you hit it there. Revenue setting the slow, revenue growth setting the slow. 11.9% in 2022. If you didn't hit on that, but then looking at revenue growth of only 0.4 year over year for 2023, and that's really the real big takeaway. But it is being priced in, and it's just a lot of these names that we've talked about in recent weeks since we started the podcast. It's important to see the names where these revenue growth has already started to chunk down. Now, again, it's an expensive stock. It's not cheap, but it's not extremely expensive. So the way I look at it is it's been right outside the top 5 holding of ours before, but at levels where we see a lot of value. And look at this. I mean, you see, let the chart tell you where you want to be buying it. It broke out middle of 21. And it's come back into this back test. And the back test is the area that you want to be looking to buy it. And we've recently hit that higher end of the range that it broke down from up near $600. So ultimately, I think you want to find it. We may not see it at 500 again. Maybe we would, but that's obviously the range you want to buy it as this thing comes back in. So I think it'll be interesting the next couple of weeks. Obviously, next week it reports earnings. It's already reacted negatively to Danaher. It's in the teens, say 13, 14, 15 number holding for us. So it's backed away, but it's also, again, it's something that we've ebbed and flowed with as we've had opportunities, and we like the name. It has a place in your portfolio. So let's move on. The next one, CSX, which reported yesterday, traded lower. One thing, we haven't owned CSX. It's always been sort of on our radar as a rail to buy. Their port exposure is real terrific. It's multiple. Was it? It's multiple low relative to, drawing a blank on it, but
Yeah, it's a 17 multiple.
Yeah, 17. I mean, it's right around the index. I think overall, the port exposure is something I think is important. But as you see, say China open up and others, that could be something that really we see a good momentum coming out of the stock. But as we face the headwinds of, is this a soft landing we're going to see? Is this going to be a hard landing? Is it going to be a recession? Now, the GDP numbers today, the consumer spending we're highlighting, doesn't signal a recession. Now, if that's the case, we're going to see rails perform. But one of the things that is thinking about too, as the housing market slows, and I heard this from somebody. It was a colleague that was on the halftime report yesterday. I thought it was a great point. Lumber and moving lumber, from place to place in order to build houses. If the housing market has slowed, these demand through the rails is going to slow. That's something to really keep in mind on. Now, looking at the multiple at 17 now. It was at 12.5 in the great financial crisis. I don't think we're going back down to that level. So there is, I think, quite a bit of value to be looked at in this range here. The question is, are we out of the woods? I'm patient here. It's a name that, again, we'll keep an eye on. What do you have here with the data?
Yes. So multiple is a really interesting point, comparing it to the great financial crisis in terms of, rails are a levered play on the economy. You get a little bit more than GDP growth with some of these. Management did say that they are still capacity constrained. So it's not as much a question of demand, but more a question of can they deliver and add that additional capacity. There's been a lot of moving parts with labor availability that has impacted their own ability to run the trains on time, run the trains at the velocity that they need to run them at. So those are some of the headwinds. And then we also saw the merchandise volume trending down, and along with it, the margins also trended down. But ultimately, rails have a lot of pricing power, so I'm less concerned about that. They did note continued strength in the coal segment, although because their contracts are directly tied to coal prices, not directly, but indexed to coal prices, the recent coming off, as you can see here on the top right of this chart, Newcastle coal, they talked about Australian coal, but similar in terms of price development. So coal prices coming down, gas prices coming down is going to be a little bit of a headwind in terms of how much revenue they're going to make per ton that they ship. But yeah, ultimately they talk about domestic production continuing to trend up. They were encouraged by domestic auto production. Domestic auto production translated into domestic steel production, and steel producers need coal that CSX ships around. So that's ultimately encouraging. They have a little bit more exposure to the international market. So as Europe has seen industrial production not really decline as much as people might have thought, that's an encouraging dynamic. And then they noted the China reopening potentially driving some of the international shipping activity. But yeah, I think, as you said, it's more a macro question really with these rails. They are extremely stable plays. They produce solid returns on capital. So these are solid companies. The question is really, when is that next catalyst going to come? And yeah, I think a lot hinges on the Fed.
Yeah, and then you can see here, if you take a look at the chart, if you want to pop that up real quick, it's a there's a breakout area we tested into last year. This is the breakout going back a couple of years from that, the COVID dropout and then the breakout. So there's a lot of support in this name down here. The question is this recent turn lower? Are we going to find it from a soft landing from the economy, or is it going to get worse due to the recession? Let's move on and try to wrap this up. Funny here at this podcast today. We were going to try to keep it within the 20 minutes for you. I'm a little under the weather, traveling around a bit, but we're actually pushing it longer. You try harder to keep it short, and it takes us a little bit longer. So, Cheniere Energy, you're next. This, talking about low multiples. This is a 6 multiple forward. I think that's important, especially the space. So it's right along with its peers. The question is, what we like about here. Natural gas prices have plummeted, and it's not really marked against Henry Hub. As we see Henry Hub go below $3 for the first time since 2021, it's really marked against the contracts that they have, and the volume and the contracts they have are sticky. We like using the term sticky contracts for some of the things names that we bring up. The U.S. is also reaching 1 trillion cubic meters of production, so that's something to keep in mind. Overall, I think export. It's a good name to keep in mind. Natural gas is not going anywhere. It's going to continue to be a bigger emphasis within the energy space. We've owned this name. We owned it for a while. We monetized the name really through March last year when you had the Russian invasion of Ukraine, and then it rallied out pretty good. We monetized it. We've been waiting to see if this thing pulled back. It actually ended up making new highs. And now, I'll let Giannis hop in here for a minute. I'll show you the chart that I'm looking at. A really beautiful chart. But before we get there, Giannis, why don't you hop in? What do you see in the data?
Yes. So you touched base on the fact that the U.S. is really a leader in energy production. EQT and also Range Resources both noted in their respective earnings calls that production in the Marcellus region, which is part of the Appalachia Basin, is extremely strong, extremely low cost. So that's definitely going to help the U.S. become. We're already the leading exporter, but accelerate that path forward. And then one key theme, I think, on the back of this mild winter, which of course has helped gas prices and Europe's ability to keep houses warm, there's going to be more of a competition for the additional gas out there. Primary energy consumption by China is only 9% based on natural gas. More than 50% of primary energy consumption is in coal, so there's a lot of replacement potential. Additionally, you have the fact that Europe's energy consumption was in the aggregate 20% lower than just a year ago because they decreased a lot of the industrial demands. There's been some savings on the household level. And then ultimately, though, as all these factors return, as Asia is going to come back, China in particular, you will have some pricing competition there. Back a year ago, about 30% of Cheniere's gas went over to Europe. And in the third quarter of 2022, that was closer to 70%. The reason why that was allowed to happen was because there was not a lot of competition there from China. The U.S. is going to increase export capacity by about 60% until 2025. Cheniere's Sabine Pass and Corpus Christi project, which they will invest an additional $1.5 billion into, will be a substantial contributor to that additional export capacity. And I think this is a great play. As you said, they're making money on the volume that they liquefy rather than being directly tied to the Henry Hub prices themselves. So this is a little bit more of a stable play. You can think of it as maybe more of a midstream operator, although it's more involved on the export side of the LNG. But yeah, this is a more stable play, less linked to the prices themselves. It will be quite interesting to see not only production develop, export capacity develop, but then also what is the price competition in between Asia Pacific and Europe going to look like?
Yeah, I mean, that's really a great point. I mean, as it evolves, and if you look at trailing returns, there's that chart there, the table, the trailing returns. Go back to the next one. Yeah, you had there. Yeah, you see here. Although it's down sharply relative to its peers in the last 3 months, it's actually really outperforming when you go 6 months and 12 months out. So I think, other than outside of Hess. But it's a much more stable name. And then take a look at this chart here. Let's wrap up with that. Look at this thing. This chart is going back from the big pre-2021 move here, breaking out, and it just riding this thing higher. The question mark is, are we building a little bit of a head and shoulders top, or is it going to stay riding this trend line? I think we remain to be seen. We're patient with it right now, but it's definitely a fun name to watch, a name to keep an eye on, and I think I don't think the highs overall are in, given the energy landscape and how we envision the energy landscape moving forward. So, thanks a lot for joining us. Let's wrap it up. This is, again, the Triple Play Podcast, and we hope to see you again next week. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.